Hi guys, my name is Professor Jeff Neumeister. I'm an adjunct here at Woodbury for maybe about 10, 11 years now. I also a tax professional, a CPA. Backstory, most of my CPA background was in forensic accounting and expert witnessing. Fast forward a bit, I founded a firm, Neumeister and Associates, and decided to be full service. So that includes bookkeeping, payroll, but also tax compliance. Given that it is in the middle of tax season right now, this is a good time to maybe answer some common questions and take any questions from you guys. Right? So as you may or may not be aware, yesterday was the first big tax deadline, March 16th. It's normally March 15th, but if the 15th falls on a weekend or holiday, it's just the next big business day. Right? So the deadline yesterday was for S-corps and other pass-through businesses. Right? Does anyone here have a business? Yeah, okay. And the individual deadline is still April 15th. I think most people are familiar with that date, right? Because it's kind of seared into our consciousness and subconsciousness, because it's something we all got to deal with. Rather than kind of just giving you updates about new standard deduction and what you can and can't deduct, I'll focus on something a little bit different. And that is the fact that tax guidance is not black and white. It shouldn't be. But most of the time I find that it is portrayed that way. Right? A lot of times, how do I mitigate my taxes? Right? How do I save money on taxes? And that's what most people tend to ask. But unfortunately, sometimes that goes counter to their other goals. I'll give you an example. Let's say looking to buy your first house. Okay. Saving taxes can actually hurt you. Why? Because when you go through the underwriting process, a lot of times they want to see higher income. Right? So sometimes it's more beneficial to report more for tax purposes. Or, for example, let's say you're coming into a large chunk of money next year. So you invested some sort of startup this year, and next year you're going to come into a large chunk and it's going to take you from a low tax bracket to a high one. Okay? Because that is coming, right, and you see it coming, there could be a reason, a justification to maybe not mitigate your taxes this year. Maybe to try to shift some of that future income into the current year, right, to save a little bit down the line. Right? And then there's also other goals that could be mutually exclusive, right? Asset protection, multi-generational wealth transference, right? And so we kind of get into more complex estate and tax planning type structures and options, right? The point is that taxes, the goal shouldn't necessarily always be to just save in taxes. And our way to look at taxes, and I try to encourage clients to think of it this way, is actually, how do you pay as much tax as possible? Who wants to pay as much tax as possible? Anyone? Not really. But think of it this way. The day that you have to write a check to the government for $1 billion, it's probably a really good year. If you think about it, right? Because taxes are always a function of income. So if you have to write a check to the government for $1 billion, $1 million, whatever, you probably had a really good year. Even if the government takes 50%, hell, even 70%, you're still way ahead than the average person. Now, of course, we always want to minimize those obligations, right, still, but just a way to kind of look at taxes a little bit differently, right? Another thing to keep in mind is the gray area of tax in terms of opportunities, deductions, and stuff. It's not always this or that. Hey, Jeff, can I deduct my car for business purposes? Yes or no? Hey, Jeff, can I deduct this travel to this conference? Yes or no? In reality, it's a lot of, well, it depends. It's really not yes or no. You read blogs and Reddit boards and even things like ChatGPT, a lot of times it is portrayed as black and white, but a lot of times it's really not, right? And it also depends on your risk tolerance. So even if you can deduct something, should you? Is it worth it? Right? There's always a certain level of risk, audit risk, no matter what you do with your taxes. You could be deducting everything right. You could have receipts for every single penny. You could justify every single expense that you're claiming, right? You'd be doing everything right. You still get a love letter from the IRS or the FTB. Why? Because a proportion of what they audit is actually completely randomized. There's nothing you can do to bring it down to zero. Nothing. There'll always be some risk there. Right? There's things you could do to limit any elevated risk. Right? For example, sometimes our clients come in and we always look at their prior year's returns to see what they've been doing, to get a sense or flavor of what kind of deductions they have, what kind of risk they've been communicating to the government. Right? One definite flag, arguably a red flag, is reporting things that are round numbers. Let's assume you have a business. If you have a business, you have something in mind. If you don't have a business, just pretend you have a business for a minute. And during the course of the year, you have going out to meals with clients or staff. Maybe you travel to go to some conferences. Maybe you have to have your workers' comp insurance, liability insurance, business property insurance. Maybe you have rent. You have subscriptions to things, to software, SaaS, other things that you use. Whatever your business is, doesn't matter. What is the likelihood at the end of the year, if you start looking at your itemized expenses by category, like rent and interest and wages and stuff, that those numbers will all be round? $10,000, $12,000, $20,000. Next to nil, right? Statistically, that is an anomaly. It is not going to happen. And yet, there's plenty of folks and business owners, especially small business owners, that sometimes will portray things on their returns just like that. And I ask them, where is the backup for this? Right? You said this is $10,000 and this is $12,000. The likelihood of these all being round numbers is your better chance of winning the lottery, right? And so, I wasn't sure the exact amount, so I just kind of rounded. No. Don't do that, right? Because what happens is in the IRS's DIF system, right, it's an automated system that kind of looks for these kind of flags. It looks for round figures, right? If there's a bunch of round figures, all of a sudden your audit risk goes from here to here, right? If what you're reporting is dramatically different than what other people in similar situations report, it also elevates risk. Right? So, for example, let's say you are an attorney and you do employment law. And based on your zip code, employment law attorneys, right, they will average a certain amount of revenue. They will average a certain amount of business deductions, right, a certain amount of rent, a certain amount of wages, and all that stuff. Right? All those things are kind of factored in. Right? And keep in mind, taxing authorities have a vast quantity of data to pull from. So it's not hard to come up with very, very meaningful averages and medians in what they do. So they'll compare what other people in the same zip code or adjacent zip codes in the same industry, same age, same type of work to others. And if what you're reporting is dramatically different than all these other people, tens, hundreds, thousands, tens of thousands of other people, flag, right? And again, higher audit risk. Now let's say that you do get subjected to a love letter from the government, right? It's not the end of the world, right? Sometimes those letters or examination correspondence is just saying, look, there's something that doesn't make sense in your return, please just explain it to us. Or provide the backup documents for like this one number, right? It could be as simple as that. You send it in and then it just goes away, right? It's more of like a correspondence examination. On the other end of the spectrum, be a full-fledged audit, right? Where you or your representative have to drive to a field office, sit down in a room that has no windows with an auditor and their manager and be interrogated, pretty much, right? No fun, right? It's a very different level of audit, right? Audits aren't really scary. I have some clients that are like, they're absolutely terrified of being audited. It's the worst thing in the world that could ever happen to them. And then I have some other clients that are like, I don't care. Screw the government. Like they're not going to come after me. I'm too small, or I don't care what they do, or they don't have time for me, that kind of stuff, right? It's funny that there's this such a divide in personalities when it comes to how they foresee audits and stuff, but it tends to be the case. Audits themselves really aren't that scary. I tell clients, look, if we have support for what we're reporting, it's actually not that hard to make them go away. The whole point of the IRS, really, it's a profit center. In fact, if you look at all of the governmental agencies, which ones actually generate money for the government? Pretty much just the IRS for federal and FTB for California. I mean, yes, there's some agencies that they collect fees, right? Property assessors and other stuff it's nickel and dime stuff. But the lion's share of governmental funds, their revenue, comes from their taxing agencies. Okay? Which is kind of bonkers considering knowing that, right? And this is the school of business, right? Knowing that when actions are taken politically to undermine their ability to generate revenue. It's crazy, right? Oh, let's defund or cut the budgets for the one agency that's actually making us money, right? It's crazy, but it does happen. In terms of audit risk by type of return, income threshold, yes. So again, there's always going to be, even if you're making $10,000 a year and you do everything right, and technically there's still some risk, right? Because there's always that random component, right? It's very low, but it doesn't mean it doesn't exist. It's never 0.000000 to infinity, right? It's maybe 0.00001 or something, right? But there's always gonna be something there. The more you make, the higher the risk, right? The more complicated your returns, the higher the risk. The more business or businesses you have, the higher the risk. The more stuff you do between states or cross-border between our countries, again, the higher the risk. Right? All those things could help build into your elevated risk. Right? Now, there is a website. I don't recall the name offhand. I think I actually might have mentioned it in the webinar I gave last month. But there's free public information. You can just Google it. Forget the website, Tax Institute or something. You can look at what the current audit risk is by return type. And what they do is they just aggregate public information from taxing agencies for the last X number of years and to compute what the audit risk is by return type. I think for 1040s, individual returns, it's, I want to say like 1% to 2%. It's pretty low overall. Schedule Cs, right? So if you have a business, but it's not a separate return, it's not a S Corp or C Corp, a Schedule C business like a sole proprietorship or single member LLC, so that gets reported on your personal return, those do have a higher risk of being audited. Right? Now you get into maybe 3%, 4%, right? But just kind of across the board, you're not looking at double digits. You don't get into double digits until you start triggering a lot of things that elevate risk, right? Again, doing things cross-border, making millions of dollars, so forth and so on, right? But even if the risk is low, it still should be weighed against what you're doing, right? So I have a clients that, they ask kind of, well, how much can I deduct for meals? And I'll say, well, how much of it was ordinary and necessary for the generation of the corresponding revenue? Well, I guess some of it, all of it, okay, now imagine yourself in a room with an auditor and they ask you that question. How much of it could you reasonably justify? Not just through documentation, but through your explanation. Well, yeah, probably most of it. Well, I said, okay, there's your answer. If you believe you can adequately defend a position through explanation and third-party documentation, then there really isn't much risk, right? Maybe your audit risk is elevated, but the way of defending it is equally there and can offset it, right? Now, how often do business owners deduct things like Starbucks? Let's say they go to Starbucks, they have an addiction, and they go every single day, twice a day. Is every single one of those visits related to meeting with an employee or a coworker or prepping for a meeting, that kind of stuff? Realistically, no, right? It's a personal habit that they're running through a business. Very common, right? Is there much risk in doing that? Well, maybe twice a day is a little bit much, but if they go a few times a week, Starbucks, $5, $6 here and there times 50 weeks, a few $100s. Is a few $100s of business deductions that is maybe not entirely necessary, ordinary for the business. Is that going to translate into an audit? No, not really, unlikely. In the case if it were audited, would the auditor look at that and throw the book at them? I'm going to assess all kinds of penalties, interest because that $300 was improper. Again, unlikely, right? It's cost versus benefit. Again, I am not advocating anyone to deduct anything that is not justifiable, ordinary, and necessary. I'm just pointing to the practicality of how to look at these things. There is some of that stuff. For example, if you're an educator, you could deduct, I forget if it's like a few $100s of like supplies related stuff that's not, whether it's reimbursed or not. It's just like a separate itemized thing, and it's not part of your Schedule A. So there are a few little things like that, but to your point, it's not much. It's a couple $100 here and there kind of stuff. Right? The lowest hanging fruit for someone that does not have a business is usually be home ownership. That's probably the top of the list. Right? Because if you own a home, that's, especially in California, it's almost a guarantee that's going to be better than the standard deduction. Right? Because now you could deduct mortgage interest, you could deduct property taxes, right? And you also have something that's appreciating in value that when you exit it, so long as you lived in it, a certain amount of time, you don't have to pay capital gains. Right? If you own a home, primary residence, and you live in it a certain period of time, and let's say you're single, and you sell it for profit, $250,000 of profit, tax-free, right? Huge win, right? Because at $250,000 at 20%, it's $50,000 of tax you don't have to pay the government, right? So they really incentivize things like that. And then if you itemize, then things like charitable donations also, and those could add up a lot faster, right? And there's a few other little things in there too, right? But I think getting into itemized deductions is usually one of the lowest hanging fruit things, right? As well as contributing to retirement plans, right? Deferring those taxes as much as possible. That's exactly it. And that's the whole point of the standard deduction, right? So just recap. So there's two deductions you can get. Well, one of two, right? And you always take the higher of the two. There's the standard deduction, right? Which is you don't itemize anything. Have a business, don't have a business, it doesn't matter, right? You get a deduction for just existing, pretty much, right? Single, it's a certain amount. If married, found jointly, it's double the amount. I forget what it is this year, 30,000 or something like that if married. But to deduct more than that, then you have to itemize as an individual, right? But it's hard to exceed that threshold, exceed the standard deduction for most people. So that's why I point out the easiest way to get into itemizing is usually home ownership, right? Because the second you own a home, again, especially in places like California, your property taxes alone are usually going to be more than the standard deduction. Yeah, so with a business like that, let's say a startup business, keep in mind that's separate from the standard or itemized deductions. Standard and itemized deductions are on the individual side. Okay, you get that whether you're in a business or not. Right? The business deductions, for especially like a new business, could be deductible whether you're a sole proprietor. In other words, you just went out on the street now and started a lemonade stand. It's a business. You don't have to file anything with the state. You just say, hey, look, I'm a business, I'm taking money, and I'm paying expenses. Right? The advantage of organizing a formal structure like an LLC or an S Corp or something like that is really liability protection. Right? And keep in mind, I'm not an attorney, so I'm not giving legal advice, but I'm just saying that's normally one of the driving reasons to have a formal structure. Right? And whether or not the business is making money doesn't prevent you from deducting those expenses as a business owner. So again, you'd say you start a business, a consulting gig of some sort, doing something online, training people on how to use AI more effectively in their business, whatever it is. And you invest of your own money, $5,000, $10,000. In that first year that you have zero revenue, right? Because you're just building up a name for yourself, you're building a website, you're doing all these little steps to kind of build an actual business. Even if you had no revenue, you could still deduct those business expenses, right? Even if you didn't form an LLC, you can still deduct those business expenses. It'd go on your Schedule C, and you'd be a sole proprietor, right? Again, the same thing of just going out there, lemonade stand, saying, hey, I'm in business, whether you made money or not. Now, where it can be a little tricky is if you start a business, and year one, no revenue, but lots of expenses. Year two, no revenue, more expenses. Year 3, no revenue, lots more expenses. If there's that kind of pattern that says, hey, government, look right here. I might just be looking for a way just to deduct personal expenses, right? Or have a hobby and that I get a deduction for. And they will look at that, right? So if you have a business and it shows little to no revenue and losses year after year after year after year, just know there is going to be a point in time where it's going to draw attention, right? Now, if you are legitimately trying to get the business off the ground and it's just not going somewhere, and you could prove that, right, through concerted efforts, evidence you've been having meetings, all the things you've been trying and it's just not going somewhere, then again, an audit's not that scary, right? If you could defend that is a legit business, you're throwing your own money in to build this thing out and it's not turning into something, then it's okay, right? It has a different characterization. And that's going to be a little more a legal question in terms of entity structuring, in terms of what might be best practice. And also if you have something you intend to start as a business and it just shows no income, no profits for several years, again, a lot of times they say 3 years is a go-to. If you have a 3-year period and there's still nothing being shown, then that is going to raise the question, like, is this a business or is this something else, like a hobby? Yeah. So just kind of recap the takeaways. Taxes are not black and white, right? In terms of what makes sense, right? You need to think kind of holistically. What are your goals? What is your taxes going to look like next year? Are you trying to buy a home? Are you trying to get a loan? Are you trying to maximize the value of something today to make it more cost efficient for your heirs, your heir parents? Right? It's not this or that. Same thing, can you deduct something? It's not going to always be yes or no. It depends, right? It also depends on your risk tolerance. Yes, deduct only what is actually genuine and ordinary and necessary if it's for a business, right? But there are other factors to consider as well, right? I'd say always, in doubt, confer with a professional, not just online. And as wonderful as ChatGPT and some of the AR platforms are, I use them. I do find them giving incorrect advice. I'll ask it to recap a certain tax code, and then I go and vet to make sure before I use any of it. I do find errors. I'd say probably about a good 25% of the time. It's enough that if I just copied and pasted things blindly, I could be subject to malpractice and giving incorrect advice to clients, right? And that's me as a professional. So if you're relying on something that has that kind of error rate, just be very mindful, right? It's really great for researching areas to research a little bit further, right? Always reference the source information, right? But otherwise, thank you guys. If you want to ask any personalized questions, I'm more than happy to answer.